Good morning, everybody. This is Monday, May 23rd, 2022, and this is John Blank, Zacks Chief Equity Strategist and Economist. And today we're going to go through a fascinating and almost certainly interesting review of a market all of you care about, which is the U.S. housing market. Before we begin this, let's go through the typical disclosure that I need to make to all of you. I will only read the first line. The rest of this, I would hope that you would understand by now, but please review it. It is important to understand that this is the views of John Blank, PhD, myself, are not necessarily the views of Zacks Investment Research. Past performance is no guarantee of future results. So keep this in mind as we journey into the U.S. housing market. So my title today, 10 key insights for the U.S. housing bull and bear debates. Obviously, this is a major debate out there, and I need to inform all of you of these 10 key insights that are going to help you deliver a better story in these debates and find a better way to make better decisions about the U.S. housing market. It affects stocks, it affects wealth, it's going to affect the economy and the US for sure, and probably across the world as those effects expand into all these different markets. So part one will be financing houses, the incomes of people, their savings, and the effects on home prices all of this just had. So we'll spend a little bit of time on the individual level. And then the second part will be a deeper dive into aggregate demand and supply. So we'll get into the larger, bigger picture stuff. So it's micro, macro. And I'm going to give you 10 key insights. I'm going to number them, by the way, so you can come back later for these slides and find your way to the better ones, to the better insights, to the better stories in your debates as you go forward. So, number one, financing houses, incomes, savings, and the effects on home prices. It's all of this, by the way. It's not just the mortgage rates. We're going to get into that first, which is the typical story we're all looking at with the 20, 30, 5-year Treasury yield is at the top, and the 30-year fixed rate, 15-year fixed rate, and the 5- and 1-year adjustable mortgage rate are at the bottom. So this has been everybody's fixation. Number one, the fixation on the U.S. Treasury market and its relationship to the U.S. mortgage market. As you can see, the latest high, quote, high fixed mortgage rates are actually nothing new. This is actually something we saw as recently as 2018, albeit briefly. And we've got a new level here for you, which is somewhat around 5% on the 30-year and a little bit less for the 15 and the 5-year. And that corresponds to about 3% on the 10-year Treasury. So 10-year Treasury at 3%, 30-year fixed rate at 5%, that's the 2% difference you need to understand. Now, what you can see here is we can go to 09 levels, which would be 4% on the 10-year, and that would be 6% on the mortgage rate. I don't think we'll get there, but it's the other, outer condition that's probably going to appear now and again. And this is concerning everybody. Number one, there certainly are higher Treasury yields on hand. There are certainly higher fixed rates on hand. This is certainly number one condition. All right, number two condition, the actual state of the mortgage-backed security market. We all know this is a big problem in 2008. What I want to point out to you is the top slide, the U.S. mortgage-backed issuance. That's the top line. It's between agency and non-agency. Remember, non-agency, the private bank securities were the problems before. And as you can see, they are now, the issuance is collapsing quickly in front of the collapse of the mortgage market. So is this where the problem is again? We don't know. The previous existing non-agency mortgage backs were rising throughout this. Now they have collapsed. And you can see across the trading volumes and the securities outstanding that it's really two different markets. It's the Fannie Freddie market and the private mortgage-backed market. And we've already seen number two insight, which is there's been a collapse of issuance, particularly on non-agency securities. Concerning. All right, number three. Shelter CPI. That is not the CPI, it's the shelter CPI. That will be in the blue line at the top. And then in the middle, I'm going to have the real disposable incomes. All of those have obviously gone up. You can see that orange line which is just jumping around because of the payments to people. So you've got another story here that another thing fueling the housing market for the bulls is that real disposable incomes certainly have gone up, as you can see in that middle chart. And the household debt service ratios at the bottom across this entire period have gone down. So for the bulls, real disposable incomes have gone up, household debt service ratios have gone down. Number 4, another few important parameters to the housing market. I have 3 slides together. The top one is the most important, the monthly supply of homes in the USA over the last 20 years. It's not even close, as you can see, to the prior situation, 08, where we had 12 to 13 months supply. We have a standard 6-month supply right now. It really has not moved around a lot. Until we see something here, we certainly shouldn't be concerned. And also look down at the bottom. Also for the bulls, there's a long serial decline in both rental, which is the black line. Black line, I mean this line. You can see that rental delinquencies vacancies is very low, and that has also gone down for both housing and rentals. So the rental and housing market in terms of vacancy rates is very low and lower than it's been for a long time. So all the markets, rental and housing, are tight. So number 4, tight rental and housing markets. Number 5, household savings rates. Owners' equity in real estate from the last 20 years. And you can see again, savings rates are incredibly high, and owners' equity in real estate in the center and bottom is also quite high. So for the bulls, household savings rates are quite high. For the bulls, owners in equity in center and bottom is also quite high. Number 6, top channel here, median sales price of U.S. houses is extremely high. That will be either of these points. I've got the median in black and the homeowners sold for the United States in blue, and you can see that both are at record highs. You can also see in the middle that housing median days in the market is at a record low. So the top is bearish. There are record high prices. The middle median days in the market is bullish. It's very, very low. And the bottom is the delinquency rate. And this is mortgage-backed residential real estate or commercial rate real estate, which is blue. There's very little delinquencies, which is bullish. So again, here you got one for the bears, which is the top median sales price. The other 2 are for the bulls. Number 7, home prices for low, middle, and high value housing property. So I've got the high value at the top, I've got the middle value at the middle, and I've got the low tier values at the bottom. Now, what you're going to find out, no matter it's high, middle, low, luxury or very entry-level homes, that the South and the West Coast are highest. That would mean Tampa is highest at the top, LA is highest in the middle, Seattle is highest in the bottom. Minneapolis is at the bottom chart, it's at the lowest, and Chicago is at the lowest in the middle and top charts. So point here is the northeastern cities, the Midwestern cities are not the hot spots. And there's a lot of hot spots out there. There really is no obvious value advantage because people are paying up for warmth. And that is number 7, bullish. People are buying the South and the West. So as you can see, I've got more bulls than bear slides, which is why I think this talk of a housing market slowdown is probably premature. But let's continue now into the aggregate story. A deeper dive into the aggregate demand and supply. So I've taken you through all of the stuff about the individual. I've given you a lot of different points to talk about. Now we're going into the big picture. First of all, housing and allied segments contributions to GDP for the last 40 years. As you can see, residential fixed investment did take a dive in that 08 period, but it has recovered. That's this line here. And this is really what we want to focus on, is residential fixed investment. We don't want to bother with GDP, and we don't really need to put in all this other stuff. This is the services stuff and other things that have to do with housing around it. This is the line that we would like to see if any cycling is going on. As you can see, it happened for 5 years, a long time ago. This is probably also somewhat bullish because there was a true collapse in investment for 5 years in residential fixed housing. We're still seeing the effects of that now. So GDP measures of housing demand bottom thing I want to point out here is down here. This is the building materials and consumer confidence and furniture and all these other groups. And as you can see, they've all stayed up quite high. So this is a very strong market in its allied areas, as well as these stronger GDP structures indices. So again, I don't see, when you look at all of this, or all of this, or all of this, that I see much in the way of bearish news at this point in time. So number 8, the US home price and construction indices, and I've got 5 of them here for you. And again, we'll go through all of this in detail here. Number 1, the Case-Shiller, that will be the blue line here. This is Case-Shiller, let's say repeat sales, which means you have to have a house that is sold twice in their index to get in there. This is a broad one. This will be the all transactions house index. So this is a much different one. This comes from FHFA, but as you can see, this is bearish because both are very high. No matter what you look at over time, the US house price indices are at record highs. This is the bearish case. Number 8, Case-Shiller National Home Price Index is very high at a record high. The FHFA all transaction home prices also at record highs. Down here, an interesting set of mixes here. Dodge Momentum Index. This is a monthly report. It comes out with a 12-month indication for construction spending. So the Dodge one is the blue line. I'm going to show you that here. This is also very strong. A lot of construction activity, very bullish. And then we've got this home buyer affordability composite, which is actually at a very low level. So home buyer affordability is bearish. There's very low affordability at a very high price. That's bearish. Now, the bottom one is the National Association of Home Builders Housing Market Index kind of composite, and that actually still remains quite high. So as you can see, we've got the construction activity holding up really well. That's strong. You've got affordability down, and you've got the overall story basically pretty strong. So again, this is, I would take 8 as a win for the bears, and we'll move to number 9, which is the number of US housing units transacted in different segments. So I've got all kinds of stuff here: new single family home sales, building permits, houses for sale, construction, etc. But as you can see, let's go through a few of these things. So private housing units authorized, permits, this is building permits. I mean, again, very bullish, very, very bullish. In here, we've got houses sold. And again, it's not as high as 2020, but it is very high relative to history. So the market is still hot. Down here, we've got construction. That's that blue line, and it is very, very strong. So again, I'm going to give number 9 to the bulls. All right, total construction spending is at top, and now we're going to tip into the global housing lending markets. So up here you can see, no matter what I'm looking at, again, very strong construction spending in the United States. Very strong, record high construction spending for the bulls. Down here, all of these various lending rates, whether it's China, United States, Canada, Italy, Japan, UK, India even, are very much going down. So even though we've yet to see this rise in rates outside the United States, it certainly will be from low levels. So that is also fairly bullish. So number 10, global top 10 economies. Taking a look around the world. And I'm looking at inflation adjusted real residential property prices. So US and Canada up here. You probably may not know this, but the Canadian market is every bit as overheated as the United States. That's what I wanted you to pick up here. Here we've got the UK and Germany versus China. And you can see, if you're worried about China, forget it. Worry about UK and Germany has a much worse situation, right? Here we've got Japan versus Canada and US. Definitely US and Canada. Here we've got UK and Germany versus China. Definitely UK and Germany. And down here, we've got India and South Korea. And at the bottom, we've got Italy. So Italy, for some reason, and I expect it has to do with the way they handle mortgage finance, probably a lot more cash has to be put up in Italy. So they do not have a housing price situation in Italy. But as you can see, it really is Italy and Japan, and frankly, China, that is not as concerning. So this is actually, again, bearish for everywhere, and actually somewhat bullish for China. And I think that is probably a statement that you all have to scratch your heads and review this, because you will not believe I said that, but I just did. All right, so let's take a look at construction. At the top, I've got Japan and the US. The middle, I've got France, Italy, and South Korea. At the bottom, I've got Germany, the UK, and Canada. One thing I want to point out here is that South Korea has a strong construction growth, and this is true particularly after the pandemic. So South Korea is showing you that construction growth is pandemic related, because they did a very good job with COVID. It didn't matter. People really bought into the housing story in Korea. Is this true for Italy? Yes, it also is true for Italy. So the prices didn't go up for Italy, but the construction did. And this is showing you that no matter where you look, the United States, Korea, or Italy, you're seeing more construction activity. I would tell you that the only place that didn't see that would be Germany. Again, I don't understand the German market story. I would assume part of this has to do with the Russian situation now, but how it played out earlier than that is something that I simply do not know. But my point here is that construction spending is bullish. After COVID hit, it was certainly the case that everywhere in the world, other than Germany, saw a lot of construction growth. All right, so I hope you enjoyed that today. Obviously, this is a lot of stuff, and I've got 10 key points for you to review, and I need all of you to get these slides and review them in detail. There's just simply so much here for you. There's so much you can learn, and I think it really is the most important story out there in the US housing scenario as we play through to trying to figure out whether a recession comes out of it. As I can tell you today, surprise, surprise, I'm more bullish than bearish on housing, even in the face of higher interest rates. It's going to take a long time for housing to take the US economy down, if it in fact does. And I think that needs to be kept in mind here. We've got a record high savings rate. Inventories are not out of place. Lots of construction spending, most everywhere you see, other than stray places like Germany. And it's certainly COVID related. And the era of COVID is about strong housing markets. How the Fed reins that in is going to be a major challenge. But I will tell you this, you're probably not going to find an 08 crisis in this data. It's going to be a slowdown of some magnitude. There are some bearish points here, but it's certainly not the case that the bulls have nothing to hand in here. I have, of those 10 points, I think I probably give 7 or 8 to the bulls, 2 or 3 to the bears, and that is where we stand today. So if you want any of these slides, here's what I would like you to do. Call 866-794-6065. That's the best way to get a hold of Zacks Professional Services, or send us an email at strategycall@zackspro.com. We've also got a LinkedIn and Twitter space for you, and we've got a website, zackspro.com. Any of these ways are ways to get a hold of these slides and contact us for subscriptions and for more information. And of course, the insights that are in these slides, the only way to get those is to contact us, 866-794-6065, or the email strategycall@zackspro.com. I hope you enjoyed this. And that is the story we have for you in US housing in the United States and around the world. 10 key points on housing.